FSN Radio. It's all about what's next. Go to financialsurvivalnetwork.com and sign up for your free weekly newsletter. You'll also get 3 free reports. The Financial Survival Network. It's all about what's next.
Welcome. You are listening to the Financial Survival Network. I'm Kerry Lutz, and today is May 8th, 2020. Well, we've certainly seen unprecedented disruptions, unprecedented interventions by both the federal government and the Federal Reserve, and so much more. It's going to last for years, if not decades or generations. I want to know your opinion about the interventions, about what's happened, about the collapse. Where do you stand? How has it affected you personally? I really want to know. Love to hear from you. KL@kerrylutz.com is the email address, KL@kerrylutz.com. Well, you know that we like to get new guests on here because you get new perspectives on things, especially, you know, that I'm really into economic history. Economic historians are always welcome on this show. And we're really pleased to have Dan Oliver. Dan, you're managing partner at Myrmikan Capital. And you're also the head of the Committee for Monetary Research and Education and an economic historian in your own right. You've got a book coming out about credit cycles and economies going back to almost prehistoric times, almost back to Adam and Eve, I might say. And we're thrilled to have you on the show. So when you look at what's going on here, and I read your latest newsletter, really, there's nothing new happening here in the economy. It's just the scale of it and the complexity of the global economy that put this in a whole nother league.
Well, I think that's right. I mean, as you alluded to, credit bubbles go back as far as history. There were 28 debt cancellations in Mesopotamia, and the first well-recorded debt collapse occurred in Athens. Some things never change, in 594 BC. So my whole thesis is that human nature doesn't change, and neither does the broad stroke of human history. So if you study history, you get a good sense of what the present, where you are in the present, and where you're going. As you mentioned, this current collapse, there's nothing unprecedented about it. They don't always get caused by pandemics, of course, but it's important to remember that this crisis did not begin with the Wuhan virus, as I call it, using the traditional way to name diseases, not the WHO, Communist Party sponsored naming conventions. It began in mid-September with the Repo crisis. If we step back a bit, when Bernanke printed up $3+ trillion to bail out the banks from their bad bets in the housing market back in 2009 and 10. He testified several times to Congress that this would be highly inflationary if it were permanent, but not to worry. Once the crisis was over, the Fed would be sure to return its balance sheet to sensible levels. And of course, people who are from the Austrian School of Economics knew that would never be possible because a bubble economy requires not just low interest rates, but constantly falling interest rates to keep an even keel. And so to their credit, forgive the pun, they did attempt to shrink the balance sheet. That's what Powell was up to. And they got to a pretty high level, and all of a sudden the wheels started popping out. And the first those wheels to really pop out actually happened back in June. No one noticed. It was very technical when the Fed funds rate went above the interest rate on excess reserves, and they had to rejigger those numbers. No one really noticed that, but I didn't write about it at the time. But then, of course, the headliner didn't occur until mid-September, and as you'll recall, there was a convenient explanation, which was, it was corporate taxes were due in mid-September, and so there was too little cash to fund the banking system. Well, okay, but tax payments come every quarter. Not just that quarter. And either you can have too little cash for something, or you can have too many assets to finance, which, of course, again, people from the Austrian perspective understand that was what was really going on. It wasn't too much cash, too little cash. It was too many assets. And what are the assets that could no longer be funded? Treasury bonds, i.e. funding the deficits of the state, and mortgage-backed securities, because, again, there's a new housing bubble going on where they're madly building office towers and residential communities. So So they can't finance these things. So when the Fed stepped up to, quote unquote, stabilize the repo market, what they were actually doing was putting money into what has now become the main funding mechanism for these two activities. So they were essentially printing money to fund the state and to fund housing. And it should be no surprise again that the Fed again promised, as they always do, oh, well, this is a temporary phenomenon. We're going to back out of it as soon as the crisis ends. Of course, the crisis never ends. And to be sure, no one saw the Wuhan virus coming, but it was going to happen anyway, as we discussed off mic. I mean, in a way, they needed this because it becomes a scapegoat for them. But we were heading this direction anyway.
Yeah, the markets saw it. And I knew back in September that the repo crisis was a big, well, as a presumptive Democratic nominee, Joe Biden would say, it was a big effing deal. And I knew it because this is the most staid market in the world, repo market. The banks have their junior most people or the oldest people that they want to push out the door running the repo desk. And all it is, okay, we got this, take this collateral, we'll give you money. And what led me to believe was that during this, that a couple of banks actually collapsed, or hedge funds, but the government wasn't telling us. And that still might be the case. We're never going to really know because they're never going to say. But what I found really, really interesting was a couple months later, they came up with the explanation, well, JP Morgan Chase just pulled out of the repo market, pulled $112 billion overnight lending out of the market. Why would JP Morgan do such a thing? Well, JP Morgan is always a couple of steps ahead of everyone else in the market, the same way, and I know you'll get into this, that they own unparalleled amounts of gold and silver in their vaults right now as we speak, while all the other major commercials are short in those markets and carrying potentially large losses in gold, small profits in silver, but that's probably going to change as well. So I guess I got a little off track there, but the point is, this was a big deal that the repo markets stopped functioning properly. And of course, it was going to merit a major response by the Fed.
Well, that's right, and that's exactly what happened. And so, one of the questions that I think that I was been asking myself the last few years is, when the collapse came, what would the Fed do? There's a great debate, as you know, within hard money circles. Is there a big deflationary collapse because the Fed puts money out and nobody wants it? And the example here I would give today is, let's say the Fed said to Boeing, we'll lend you $100 billion. Well, that's great, but no one's buying airplanes right now, so no one's going to Disneyland. Disney could take debt too, but if no one demands the product, the debt doesn't do anything. So that's the Keynesian pushing on a string idea, where the Fed just can't do anything to help. The flip side, of course, is that there's one actor in the economy who's always willing to borrow money and always willing to spend it immediately, and that's the state. And so when the state says, okay, we're going to borrow, I think it was $3.5 trillion. The baseline was to borrow $1 trillion this year, and there was lots of chatter about who was going to buy it. Now the baseline is they're going to sell $3.5 trillion of debt this year, and that's before they pass the next stimulus, which they're already working on. So that number could go north from here, and then next year the projections are, I think, $2.5 trillion or some number like that. So who on earth is going to buy all that money? And of course, the answer is the Fed. But that is how the Fed can use its debt-creating power to actually create inflation, because, again, they lend these treasuries, so that they buy these treasuries, lend this money to the Treasury, which then spends it immediately on these bailout programs. So I think the whole inflation-deflation debate is going to be settled in the inflationary side. And part of that, too, again, is I've thought for a long time, which is that, yes, the market always wants to liquefy these structures and these malinvestments and send the prices down. But as we all know, the Fed's in its DNA is designed to prevent a banking collapse, from a 1930s-style banking collapse. And so whenever you get those deflationary moves, the Fed's going to run in and print the money. And that's what happened in March. I mean, that was a classic crash, which in the 19th century would have kept going. But then the Fed came with enormous firepower and reversed it. And I think that tension will just get bigger and bigger. And if you look at hyperinflationary economies, and I don't think we're there yet. We can get there, but we're not there yet, certainly. But as you go down as you spiral down the toilet bowl, the volatility keeps increasing. And so these deflationary moves get more and more powerful, and then the inflationary response has to be that much powerful as well. And so if you're an investor and you're using margin debt because you figured out that, hey, they're printing money, the stocks only go up, that's a great way to go broke because you can be off sides when one of these deflation moves happens and that takes you out of the market.
Okay, and this brings up one of your philosophies that we talked about pre-call, and that is the use of precious metals and select junior miners as a hedge or an insurance policy against the very events that you're talking about, not to have all your assets wrapped up in the sector, because that's a prescription for disaster. Because of any sector of the market, the junior miners are by far the most volatile and the most the returns can be stellar, but the losses can be life-changing as well. And that's why you can't get so into it. But effectively making an out-of-the-money call bet on precious metals with a small portion of your assets, out-of-the-money call option effectively is what you're doing when you do this. Because, hey, if silver hits $50 again, silver is the only commodity out there that hasn't made a new high in 40 years. It hits $50. And that will be put those few silver miners left, pure silver miners, that will be like rocket fuel for their stocks. And so much of this. So going back to your economic historian hat, put that on again. And when you look back at all these credit busts, is this more like tulip mania, or is it more like the Mississippi land bubble? Or the South Sea bubble? What's the best analog for what we're going through right now?
FSN Radio. It's all about what's next.
Osino Resources is a Ross Beatty-backed gold exploration company in mining-friendly Namibia. Osino's district-scale land package is situated near two producing gold mines, one of which Osino's management team previously developed and sold to B2 Gold. Osino's founders and management are experienced mining professionals who have already successfully developed and sold two companies in the past 7 years. Osino has a tight share structure, and with its current treasury, it can self-fund the advancement of its gold discovery into at least 2022. This is an exploration company with drills turning that you'll definitely want to pay attention to. Osino trades in New York under the ticker OSIIF and in Toronto under the ticker OSI. To learn more, go to osinoresources.com. That's osinoresources.com.
The Financial Survival Network. It's all about what's next.
Well, let me get there, but first I just want to back up and add to what you said about junior miner companies, and that is what I like about them is that they generally have no debt on them because no one will lend to them. They're too small.
Who in their right mind? Who in their right mind, right? Dan is going to loan to a junior miner.
Yeah, that doesn't mean they're not risky. They can print you to oblivion, but they're not going to default on debt. And what that means is that you really are seeking after operational leverage, which is a very different beast than financial leverage, and that's what you want in this kind of environment. Is you want leverage, you just don't want to be in a position where you get a margin call and forced out. If you have debt also that comes due a very long time in the future, then again, the ability to make coupon payments is usually pretty mild. Like a mortgage, for example, you don't usually, unless you're a stripper buying 10 houses, usually you make your mortgage payment. But the bullet payment or the capital payments are so far in the future that they'll melt away. And again, I don't mind producing companies that have debt as long as that debt isn't due in the near term. Because if you have to refinance a debt in a crisis, you got big problems. But as long as the debt is due 4 or 5 years out, you're pretty immune from these deflationary moves that I mentioned about. But back to your question about analogs, in my view, the world and the U.S. and the world at large is in the grip of the largest credit bubble that history has ever seen. And one reason is because there's never been a time when there's no country currently that is based that has a currency based on gold and silver. It's all central banks, and the central banks have been entirely unleashed. There were central banks in the past, but they usually had parameters within which they had to operate in terms of leverage, in terms of having gold as a reserve asset, things like that. And that is no longer the case. The Fed can literally do anything. There are laws about saying they can't buy equity and they can't buy corporate bonds and those sorts of things, but we just saw the men run that. They created these special purpose vehicles that can do those things. So, they got clever lawyers on staff that can figure out how to get around whatever restrictions are on. And in fact, if you look at the history of the Fed, that is how it's operated. It's always breached the laws about what it can do, and then Congress later amends the law to allow it to do that which it has already done. And we see the ECB doing the same thing. So we've never had a situation where the powerful countries are all run by such a banks that have no limits on them, and that's where they can push this bubble so far. Remember too that central banks don't create bubbles. Private commercial banks create bubbles, and then what happens is when the bubble pops, the central bank's job is going to bail them out. So the ability to bail them out, of course, becomes a political issue because the banks are so large. If you don't bail the banks out, you're looking at total economic catastrophe. And so what politician wants to take ownership of that? And so the bigger the bubble gets, the more mandate there is to allow the Fed to breach its parameters to bail these things out. So number one, this is the largest bubble that's the history's ever seen. The tulip mania wasn't really much of a bubble. We won't get into there too much, but there's some good articles about how it didn't fit the definition of what a bubble is. It wasn't based on banking. It was very short-lived. It was only professionals. The future contracts were canceled before the tulips were delivered, so on and so forth. The first real modern credit bubble was, as you referenced, the Mississippi bubble in France of the early 1700s, and I've written about that and done a lot of study on that. And what's interesting is that John Law, who was a Scotsman who came to France, France is broke, and John Law showed up and said, "Hey, you don't need gold and silver. I will set up a state bank, and I will use sovereign debt as the reserve instead of gold and silver, and then we can use that to create credit where there isn't any." And get the economy going again. I mean, that was his thesis, and that is precisely the thesis that every single major country operates on today. I mean, he really was the forerunner of today's financial system, and it was a very compressed cycle. But all the things we're witnessing today happened in France in terms of a stock market mania, and they think more internet than housing bubble. People out in the street madly buying stocks, and until it went to absolutely ridiculous levels. People borrowing money because effective rates were negative, and so you could borrow much money as you wanted to because asset prices were rising so high you never had to pay them back. The whole thing, and then of course you get overinvestment, you get malinvestment, you get all the excesses that we're familiar with, and the whole thing collapsed. But if you read that episode carefully, you can see in it again all the modern phenomena that we are very familiar with, because anyone of any age today has lived through a number of these cycles so far, and they keep getting bigger and bigger as the Fed keeps making them bigger.
Yeah, well, until we're going to hit the mother of all bubbles, and there will be no coming back from it. Arguably, and in your newsletter, you say when these busts happen, effectively the country is bankrupt. And bankruptcy, well, in the strict sense, in the legal term, and we both have legal backgrounds here, bankruptcy is when your debts exceed your assets, and you are effectively insolvent. But debts can also be where your debts, the ability to service them, exceeds your cash flow due to a temporary dislocation, right? So what are we in here?
Well, I mean, to your point, bankruptcy is not a phenomenon which assets are destroyed. It's a phenomenon where assets move from borrowers to lenders. And if you look back in the 19th century when there was no central bank, there were two foreigners, the Federal Reserve, but they weren't very powerful. More of these panics occurred, but they occurred more frequently, and so they were less devastating. And that is exactly what happened. Everyone went bankrupt, so the assets moved from the reckless to the prudent, and then once you had a reset, the economy got going again very, very quickly. The reason that did not happen in the Great Depression is because FDR was essentially a fascist. He took a lot of his policies straight from Mussolini's Italy about state control and putting big business and big labor in charge of the country. And so that's why that lingered on. It had nothing to do with economics. It was all political. Keynes just won't let you think that, but that is in fact what happened. And so today, again, if they let the system go, it would be horrible. Everyone would go bankrupt. All the banks would close. Everybody broke. But the assets would still be here. And so what would happen is, in a matter of months, the new owners of those assets, i.e. the prudent people, would pick it up and move on again, and from a much more stable basis. So it really wouldn't be that bad. It'd be very quick and short, and we'd be over with it. But that's precisely what they don't let happen. I mean, again, that's the Austrian thesis. They don't let the liquidation occur. And that's what causes the pain, because all the reckless actors know that they can be as reckless as they want to be, because when they hit a speed bump, the Fed's going to bail them out. If they're powerful enough, if you're some small banker somewhere, good luck to you. But if you're Blackstone, if you're one of the big institutions, Carlyle, right, and you were in trouble, you're too big to fail. I mean, this is a policy that was explicitly discussed in Congress back in the 80s, that banks had become too big to fail, and they knew it. And in fact, rating agencies began to put too big to fail considerations in their ratings, and the cost of debt would go down for too big to fail institutions. Of course, that's why there's such a big merger mania in the banking sector, because everyone realized once we're big enough, they will not let us fail, and we can literally do anything. Yeah. And so that's where we are today, which is why the collapse. And you're absolutely right; it will come. It must come. It's an economic law that it will come. Is going to be so bad.
Right, and just going back. Obviously, I agree in theory that the assets should go to the wise ones and to the people who were thrifty and didn't overexpand during the bubble periods. But the problem is here, we got because the economy's been shut down, we could have 10 million bankruptcies. And that in the case of mass defaults, mass bankruptcies, the courts are not geared to deal with this. So therefore, there has to be a legislative solution to it. And unfortunately, legislative solutions, it's a lot like sausage making. So I don't want to get into that, but just to say I agree with you in concept and principle, but there are legislative means of depriving the wrongdoers in the last bubble of getting to profit from the next, and getting to profit from their proximity, their size, the proximity to power, and let's face it, it's all one big happy club. So let me jump in quickly and just say that the credit bubble I mentioned, the first world document one in Greece of 594 BC, it was a situation where all the peasants were indebted to all the nobles, and they couldn't pay, and the penalty for non-payment in ancient Greece was slavery, which is sort of is today. If you think of student loans, they're non-chargeable in bankruptcy, but I digress. And so the city wound up in a position where civil war threatened between the haves and the have-nots, to use some Marxist language. And the solution was they got a guy who was a noble and not a lender, so he was acceptable to both factions, and his solution was to get rid of all the mortgages, to free the peasants from the mortgages of the land, and return the land to the peasants, and to devalue the drachma by 30%. That was the first currency devaluation in history. And every single credit bubble since then has followed that pattern of debt forgiveness and currency devaluation. Because you're right, if you do one or the other, you tilt too much of the economic gains that were left to it to one side. And so that is you're absolutely right. And after the Great Depression, there were lots of states that made it illegal to foreclose on mortgages. That is what Stalin did. I mean, this is something new. And that happened now.
Well, the Treasury basically devalued the dollar.
And that's exactly what's happened now. There is a quote-unquote temporary moratorium, just like temporary taxes on evictions throughout most of the country, certainly in all the large metropolitan areas. And there is a moratorium on foreclosures, on sheriff sales of foreclosed property. And that's going to continue on indefinitely. Jubilee is the only way to go here in the long run, because the debts have become unsustainable. My grandfather, who I've said this many times on the show, he had an 8th grade education, very successful businessman, didn't trust banks because he lived through the Depression. And his thing was, he always said, when you're paying interest on interest, you have a real problem that you're just not going to be able to fix. And that's where we're at now. Dan, we want to find out more about you. Where is the best place to go to read your work and connect with you?
All my letters are available free on my website, myrmicon.com, and you can sign up right there and I'll email you whenever things come out.
All right. And you'll be well served by reading Dan's work because it's got such a great grasp of history. The old saying, history doesn't repeat, it rhymes. Well, it's rhyming pretty loudly now. It's myrmicon.com. That's MYRMIKAN. There's a link to it in the show notes to this interview. As always, check it out, read the work. I guarantee you it will reap major rewards for you. Dan, can't thank you enough for coming here on the show. Anybody who has got a question for Dan, why don't you write me, kl@kerrylutz.com. Our Twitter feed is @KerryLutz. Our Facebook page is financialsurvivalnetwork.com. Sign up for free newsletter. Dan, we will definitely have you on again, and I'll look forward to seeing you at the next meeting of that august long-term organization, which is the Committee on Monetary Research and Education. And really appreciate your taking it over. If people are interested in finding out more about the committee, how do they do that, Dan?
Well, we have a website, cmre.org, which is in the progress of being redone, but the information's there, and we'd love to have interest.
Yeah, and there's a lot of notable people there. I went to one year when I was in New York, and can't thank you enough for doing that. That's definitely something worth preserving and encouraging, and I know you have plans for it, and hopefully we can help you work on those plans. Anyway, just email me again, kl@kerrylutz.com with any questions or comments. Dan, been a total pleasure. We'll talk to you again real soon.
All right, thanks for having me.
FSN Radio. It's all about what's next. Go to financialsurvivalnetwork.com and sign up for your free weekly newsletter. You'll also get 3 free reports. The Financial Survival Network. It's all about what's next.